Well, good evening and welcome to this live stream on the 13th of May, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on the show with me tonight. Thanks for taking some of your Tuesday evening out to spend it with me. It's great to see you here. And welcome for those who've been regulars and those who are new. Nice to see a few people coming in for the first time. So this evening, what I'm going to do is take you through some of the latest economic analysis, take you through some of the modeling that we've done recently, and try and draw some threads together. A few people have asked me, why do I keep pressing in on this analysis down at the postcode level? Well, it's because I don't believe that we're getting a full view of what the pressures are on real households across the country. It was hardly covered in the election campaign, and unfortunately, it's still not being covered adequately now. So the purpose of this show is to spend a little bit of time in the depths, in the weeds, but also thinking about it in context more broadly. So to do that, what we're going to do is we're going to start with the update on the market. So you can see here that thanks to Trump and the recent announcements, the markets have shot higher. That's true pretty much wherever you look. Pretty much all markets did very well. In fact, the ASX performed pretty well. The S&P 500 did pretty well too. And if you look around the world, pretty much everything is going up at the moment. What's also going up, of course, is yields. So bond yields are higher as well. And that's going to put some interesting pressures on what's going to happen with regard to, for example, the Fed rate cuts or the RBA cuts. In fact, there's a question in the poll on the chat as to whether you think that rates are going to be cut when the RBA meets next in May. So put your answer in and we'll have a look at that later on. Be interested to see what you think. I find it interesting that the high that the DAX has now got, it's hit another high, which is interesting. So if you compare that, for example, with some of the other markets, you can see the DAX is considerably up relative to where it was. And it is interesting to make some comparisons between that and, for example, what's happening over in the NASDAQ. So the NASDAQ is up. Some of the Magnificent Seven were up. But you can see there that nowhere near as high as they were at the beginning of the year. So that's pretty interesting with regard to what's happening there. And, more broadly, and what I want to try and focus on today is some of the consequences of those things. There was a nice article that Cookie Boy sent to me over to quite recently, just highlighting the fact that the tariff shockwaves are rattling the bond market. This is very important because, of course, the bond market is about the cost of government borrowing. As the bond markets continue to put yields higher, it costs governments more, and that's going to put more pressure on many households. And so that's something to bear in mind. And interestingly, when you look back, there was this question of no magic fix, says Chalmers. So, they're back in power, but there is no magic fix relating to the question of productivity. Productivity, of course, in Australia is falling behind even more than it was. Not much intent at the moment to change it. Interestingly, of course, though, the government debt is rising and could turn $1 trillion by September. And, of course, we've still got budget blowouts like the $2.2 billion metro blowout. That's the Sydney New International Airport. Just amazing. We've got costs of wholesale electricity continuing to rise. The demand for producing electricity is higher, and probably that's going to put more pressure on households, of course, as is the high cost of gas. And the gas buyers have been warning of shortfalls. Well, I've been talking quite a lot about the issue with regard to gas shortfalls and the implications. Also, it's interesting just to take the productivity conversation forward. The argument, of course, is that without productivity, the economy in Australia is not going to go anywhere positive. And the question is, can they do anything? The Productivity Commission have been talking about it for a long time. Are they going to make tax reform? Are they going to do the things they should be doing? Probably not. But of course, they will be looking to find ways to tax more. And of course, the tax on superannuation above 3 million is definitely there. The Greens want to drop it to 2 million. Don't think the Greens will necessarily have much power in the Senate this time around, given the numbers, but we'll see. And it's worth just reflecting also that if you look more broadly, net immigration, migration, Australian net immigration is still up again. So it dropped back, but now rising. This is from the latest from AMP. And this was also a very interesting take as well, which I thought was fascinating, which Cookie just sent me. The Bank of Mum and Dad is increasingly at risk of collapse because of soaring living costs and the culture of entitlement in some families where children plow into baby boomer wealth. And there was a new report from MLC suggesting that boomers need to be a little bit careful about this. So is the boomer bank under siege? Well, it could actually be. And that's going to be quite consequential because one of the things that have really helped in terms of maintaining the momentum in the property market has been the way that intergenerational wealth has flowed in through the Bank of Mum and Dad and allowed people to buy. And of course, the question is ahead, what's going to happen with regard to property? And, it's a good question. We'll talk a little bit about the contention between the expectation of higher home prices on one hand and the increased pressure on households on the other. And we're going to see both. We're going to see a horrible contention between property prices probably rising higher with interest rates dropping, but also more pressure on households and more pressure on those trying to get into the market. Just to take all this into account, this data, this was actually published by the ABC, showed that of the 227 sitting MPs, this was before the last election, I think, we found that only 12 declared no property interests. A group of federal politicians who own 3 or more properties is the largest group at 77, and a handful have very large property portfolios. You can see they're the ones at the top of the list. And it's interesting to note that it's colour-coded there by Labour, Coalition, Greens and other. So this is a widespread issue. In other words, there is a vested interest within the political machine to keep property prices rising. And this is one of the things that I think we have to come back to. We need to understand why it is that they seem to, again and again, find more ways of trying to keep the bubble higher. It's because they've got vested interests. And of course, that explains partly then the recent articles. There's been a spate of them. Sydney's $2.4 million future. Average price for houses is going to rise. It's going to rise significantly. They're talking here about, for example, families, key to higher home prices. People take account of school zones, crime rates, safety, and that means that some of the outer suburban areas are perhaps most at risk of prices rising. This was the most recent summary showing that pretty much across the country we're going to see rises in prices. And, articles go on, where will prices be in 5 years' time? Looking for the impossible dream. And this article made the point that it's getting harder and harder to buy because as prices rise higher, and despite some of the policy moves from Labour enabling first-timers to buy, the Lenders Mortgage Insurance Program, 5% deposits, all of those things, but it's going to be a heavy lift. And whilst CoreLogic's or Cotality's Tim Lawless says that prices may well rise, there's also a question of whether we're going to get a response from the regulators too. And by the way, NAB is talking about rate cuts, talking about economy booming and talking with rates of maybe below 3%. First-time buyers are likely to push prices higher, according to James Kirby, and especially because of those incentives. And it's also interesting to note that property prices probably will rise as interest rates fall. And ahead of the curve, of course, CBA made some cuts to some rates. If you've got a significant deposit, 40% deposit, you can get cheap rates. Also, just worth noting that unit prices are rising less firmly than houses. Going back to what I said earlier on, houses is where a lot of the battles are. Houses is where a lot of the growth is. But of course, a lot of people cannot afford to get into the housing sector at all, and so are forced into the unit sector. And there are some issues in units, as we'll see shortly. Now, the other factor to bear in mind, though, it's not all good news with regard to what's going on. This data point's quite interesting. This is actually the credit card data, and it shows that credit card spending is rising. More people are putting more on credit. at the moment. That's not necessarily because they're just buying more, because they're not. It's because they're having to. And that chimes with my recent analysis that shows that households are not spending more on a per capita basis. We've got a higher migration, of course, so that's helping. But effectively, we've got more people struggling. And here's the clue as to why. I've shown this chart before, but it's worth looking at it again. Look at the 55 years of property prices relative to household income. It's way off the mark. So gross disposable income per capita has been rising, but property prices have been rising more. That means that more people are actually under pressure, which means in Sydney, you need, for an average income, to be $235,000 to afford the average price. Adelaide is second most unaffordable, and that would require 47.7% of average incomes. In Sydney, it's 57.9% of average incomes. So there's a problem there. Perth is also, in some difficulty. Adelaide, though, I watch and weep because their locals in Adelaide are being priced out left, right and centre. Another little data point, tax takes in Australia are still relatively high, but not necessarily out of kilter completely if you take account of superannuation contributions. But we're paying a lot. Australians are paying a lot in tax. And of course, now the expectation is that rates will get cut. The Reserve Bank is looking, if you look through the inflation data, you might argue it. A lot of data there, but interestingly, the interbank cash implied future rate is around 3% by the end of the year. Now, that isn't necessarily what's going to happen. I would make the point that there are some, changes, particularly to bond yields, which suggest that it may not be anything like as much. The fact of the matter is that we are still seeing inflation above where it was. It will be even higher if it were not for the fact that we are actually subsidizing through taxpayer money power, particularly power support, the electricity rebates and things like that, as well as the support for the rental sector as well. And all of this means that there are significant pressures. I made a show the other day called We, the Taxpayer, Saved the Inflation Day, or did we? So have we done enough to keep inflation low enough to help the RBA argue for a rate cut? We'll see. Meantime, of course, renters are the centre of the gravity when it comes to all the issues. I made a show called Renters Thrown Under the Bus. And by the way, if you want any further data to show just how out of kilter things are, credit is growing very fast. According to the latest data, housing credit rose by 0.5% over the month. And you can see there that the amount of credit is rising, and that translates to the average minimum mortgage repayment dropped very, very slightly according to Westpac data. But nevertheless, the bottom line is we've got this debt to income ratio very high. We've got savings balances being eroded, and yet we've got home prices rising. This is the Catality data showing that in Sydney, over $1 million median value. And in Melbourne, again, a little bit of a rise over the month. And you can see there that nationally speaking, further rises. And the point I want to make is you've got this massive pull in two directions. You've got the high migration, stoking demand. You've got property investors now thinking to come back into the market possibly, but you've also got people struggling. And so this pressure is where we've got this massive contention. And, if you look at it, here is the data from, again, Cotality or CoreLogic. You can see there that there's been quite strong movements up and down. Not all markets are the same. Sydney and Melbourne looking a little less than bright over the past 12 months. Melbourne is down. Regional Victoria is down. Canberra is down. But you can see there that over in Perth, 10% higher over the year. Regional Western Australia, 13% higher over the year. So, it depends how you look. By the way, rentals are still rising, but not quite as quickly as they were. And that's translating to gross and net rental yields. Moving around slightly, but of course, nobody wants to talk about net rental yields. We will today. But the gross rental yield is the one that everybody in the marketing department of the property sector want to talk about, because that's the comparison of the price of the property relative to the theoretical total rental you might get. Around 3%, maybe around 4%, although in many places, as we will see, households are seeing net rental yields, which is the real return compared with cash money coming in. And money going out for things like real estate management and maintenance, all those other things, as well as interest on the mortgages. So net rental yield is hardly spoken about, should be. It's where the rubber hits the road. Now, this show is fundamentally about my analysis. And for those who've not seen it before, this is the modeling that we use. So we use our core market model, where we take information from our surveys, other data points, and run it through our core market model. It allows us to slice and dice the data lots of different ways. And we can look at it at a granular level, down to a postcode, of course, which is what we're going to do today. And we can also take a view as to where markets might move based on scenarios, future scenarios of where property prices may run based on where we think rates are going to go and all those other things. And so we can take the data from our stress, the price trajectory data, the buying and selling intentions, the migration, the CPI, all going into the core market model with the scenarios. And then at the postcode, region, state, and all Australia level, we can roll it up and then see where things might go. Oh, and I will just make my little advert, as I always do on these shows. If you want a conversation on a one-to-one basis about what we do and how we do it and what a particular suburb is looking like, you can have an individual confidential conversation with me. It's through my one-to-one service. This isn't financial advice. I can't give financial advice, but I can talk about my data down at a postcode or suburb level, look at underlying trends. I can look at the stress, the home price data, and also think of what might be happening ahead. It takes about an hour to do a Zoom or a phone discussion, and there's a cost involved simply because there's a lot of research to be done behind the scenes to be able to have the conversation. And at the moment, I'm still booked up. 3 to 5 weeks typically is what I need between booking up and having the conversation. And if you're interested, go to the DFA blog, use the information there to contact me, and I'm very happy to have a conversation about it. Now, let me just talk briefly about stress, because, of course, the stress conversation is what I spend a lot of time talking about, but I look at it in cash flow terms, money in, money out. This is really important because there are lots of different ways to think about stress. A lot of people talk about 30% of income going to pay the rent or the mortgage. The fact is that that isn't necessarily always a really good metric. And it's confusing as to whether it's gross or net of income tax. There are others that use underwriting metrics. Roy Morgan uses that sort of approach more, but we define it in cash flow terms, money in, money out. And as you can see here, if you actually just go through this, if households have more outgoings, exceeding one-off discretionary items than income, we define them as stressed, money in, money out. If they have a mortgage, they're in mortgage stress. If renting, they're in rental stress. We can look at investors too with cash flow pressures. They're stressed investors. And we can aggregate the data to estimate the total financial stress as well. And generally, I have the view that we can look at percentage of households and counts. The latter is probably a better view because it's the law of big numbers. And just to reintroduce you again to this chart, this is the RBA chart about the spectrum of household financial stress. They published this some time back, but it's a really, really good way of dealing with this issue, because over on the left-hand side there, the mild end is budget pressures. That's where I'm measuring it in my surveys. Some households will just continue in budget pressure land for a long period of time, but some will drift over into missing payments and then ultimately move to insolvency. The insolvency levels are still quite low, partly because the banks are extending and pretending with people, moving on to interest only, extending the terms of mortgages, all of those things. But there is a journey between budget pressures and insolvency. Not everybody takes that journey. Some people can claw their way out or sell, and a lot of people are selling with property prices moving up. But I measure it at that early point, because my argument is that if you are actually in the situation where you actually have financial pressures, then unless you change your behavior as a household and start making different decisions, then you're going to get into more difficult land later. And quite often people refinance thinking that's going to solve the problem. It doesn't. They grab more loans, buy now, pay later, even payday loans sometimes, as well as other types of loans. They borrow, perhaps pull more equity out and try and do that. But my point is, this is a problem, a structural problem. And whilst interest rates are likely to come down at some point, not sure when, the question is, will it be enough to get people out of difficulty? Now, looking at this month's data, and this is just a quick recap for those who saw my earlier show, the overall story with regard to stress at the end of April is that rental stress is at 75% of households in the rental sector. In other words, 3/4 of households who are renting have cash flow pressures of some sort. In the mortgage sector, it's 50%, 50.1 actually, come down very slightly, but it means that half of those with a mortgage have cash flow pressures. And just to bear in mind that the RBA says the debt-to-income ratio is coming down slightly to 181.9, but that is artificial because it includes all households, whether they've got a mortgage or not. If you look at those just with a mortgage, debt-to-income ratio is a lot higher than what it says there. It's closer to 6, 7, or even 8 times. A lot of new loans being written at 8 times at the moment. This was the data I shared earlier with regard to the states, and you can see there in yellow where there was a lift from last month, and you can see there that there was a lift in the Northern Territories, Victoria, Western Australia. There was a lift in rentals in Northern Territories and Victoria, and stressed investors went up in the ACT, New South Wales, South Australia and Victoria, and financial stress was higher in the Northern Territories and Victoria. Now, I will say the Northern Territory is a very small number, so it moves around quite a lot. But the story of Victoria continues to worry me. That's where a lot of the pressures are. A lot of households are in difficulty. And you can also look at it by segments as well. And you can see there that it's the first generation Australians, the multicultural establishments, as I call them, that are actually in the most rental stress. So a lot of people coming to the country are renting and getting into difficulty. From mortgage stress, it's the young growing families are the most exposed, with first-time buyers, of course, in that group. The investor stress is most extreme in the more affluent because, of course, they've got a higher distribution of properties. And overall, the segment with the highest financial stress are the young growing families, including first-time buyers. And just to put some numbers on those, if you look at mortgage stress, 50.1% means 1.8 million households have cash flow pressures. If you look at the rental stress at 75%, that's 2.3 million rental stressed households. Stressed investors at 17.2%, 511,000. And overall, 47.2%, or 4.6 million households out of the grand total of about 10 million have financial pressures of some sort. Now, if you want to go into more detail, I went in an earlier show called Households Under the Pump as Housing Costs Soar. I went through the top postcodes for mortgage stress, rental stress, and investor stress, and financial stress, and also default. So check out that show if you want more information about that, because I'm not going to go through that again now, because what I want to do is to move directly into the conversation that I want to have tonight, which is specifically about what is happening down at postcode levels. To do that, I need to share one other piece of information with you, and that is our scenarios. Scenarios are a way of exploring different futures. They're not predictions. They will probably be wrong, but it gives you an idea of sensitivities. So I have 3 scenarios. I have the best case scenario, the Goldilocks zone, where we get the rate cuts in May and later in the year. We see inflation easing. We see wages rising faster than inflation. We don't get a recession, but migration remains above average. That is, the best way that it could be. And in that case, we will see things look quite good. The base case is a softer landing with rates staying higher for longer. We don't necessarily see inflation falling as fast. We do get some rate rises perhaps later, in fact, and stay above target until 2026. No recession, but we do see a fall in migration. And the worst case, the nightmare scenario, is we've got higher rates for longer, inflation steps up again, unemployment rises, wages growth stalls, and the second order of the trade issues begin to touch Australia, and we get recessionary stuff locally and migration drops. Now, those are just 3 scenarios. I'm not saying they're the only scenarios, but they are the 3. And that then allows me to translate them directly into this snapshot down at the postcode level. And this snapshot is essentially the way of getting into the detail when it comes to what's going on. You can see here the snapshot that I'm showing here with regard to the analysis. This is actually for Wollongong. I do this particular one every time, and you can see here that we've got things like the households and what's going on with the count of households. We've got the proportion in mortgage stress. We've got some scenario work in terms of where prices might run. We've got the mix of properties. We've got the gross and net investment yields. And we've got the taxable income, which translates into what disposal monthly income and what proportion is going on the mortgage repayments. And we've also got the question of, is it multiple incomes in a household? That's when the little multi-flag comes up that you can see there. And you can see here in this particular postcode, we have 40.8% who are in difficulty, and that's pretty significant. And what I can do is to cut across to let me just do this. Whoops, just 1 second. I need to make a couple of changes, move that to there so I can see that. Yeah. And I can then cut across to that one. Oh, that didn't work. Hang on. That's funny. That one. There you go. Push the wrong button. Sorry about that. So this is the spreadsheet that's running the same data as I just showed you. And the beauty of this is now I can put other postcodes in and we can examine it. So, for example, I was asked to look at this particular postcode. Hi, Martin. Thank you for your excellent research work. Could you include Nambucca Heads 2448 in your housing survey? Cheers, Alf. So, Alf, here is one for you. Let's go back to there. Okay, so this is 2448. Okay. So the first thing to note is it's 4,400 households in the postcode. That's based off the census from 2021. I have adjusted some of the census data because I know that in some areas the population growth has been significant since 2021, but not universally so. You can see here that a lot of people own outright in this particular postcode. Relatively small numbers, 22% of borrowing and 28% of renting. You can see that only 11% are in mortgage stress. And you can see there that there's a lot of rental stress in the area, though, at 90%. You can see that 78% are houses, small number of the types of property and units. We've got a people ratio of 1.91, so that's telling me that there are perhaps some older, maybe 1 or 2 person households as well as families. The vacancy rate was a little higher than some other areas at 9.6%, but that was related to the census. The census was done, of course, at the end of COVID. And so it might be a little artificial, or it might be things like second homes or investment properties or Airbnb. Gross investment yield is 3.4%, which is pretty much line ball where it is. But the net investment yield, that's the comparison between the rental income and the rental costs for the property, is negative 1.8%. So people are losing money on average if you're an investor in this area. And you can see here that the taxable income was $56,000 from the ATO, $48,000 from the census, which gives a disposal monthly of around $3,300, with 54.2% going on the typical mortgage and 44.8% going on the typical rent. And from a scenario perspective, you can see there that the story is that in the best case scenario, prices will rise. And, knowing what we know now, that's perhaps the most likely scenario. If, in fact, we don't get the rate cuts that we were expecting and the economy begins to drift lower, then there's a bit of a fall. And if the worst case happens, then, it could drop dramatically. I'm going to focus more on the best case scenarios in the conversation today because I do think that we are going to see prices rising. So that's that one. Let me move on to the next one that I received. This is, again, people who asked me beforehand what they wanted me to look at. This one is 6630, and I'm happy to do that. So we'll switch back so we can look at that one. $6,330. So this is Mount Melville in the district of Kalgoorlie with 15,600 households, 38% owning outright, 35% borrowing and 26% of renting. You can see there that mortgage stress is at 44%, which is somewhat high. You can see I've shaded it. When it goes above a certain level, it's shaded. Investor stress not too bad, but rental stress at 66% is very high. You can see there it's mostly houses. You can also see there that the people ratio is slightly higher, so that's probably some people with families as well as individual households. Vacancy rate was quite high at the time of the census. Gross investment yield is 4.1, negative net investment yield just minus 0.4. Average taxable 63,000 compared with 70,000 for the household. Just to explain, the ATO is the individual and the census data is household. And you can see there that we're getting a disposable monthly around $4,700 on average, with 38.6 going on the average mortgage, 1820, and 31.7% going on the typical rent, 1495. And you can see here that the best case scenario is a strong rise over the next 3 years in houses. The base case, a slight movement sideways, and units follow on. So cutting back to the next one, this is postcode 2304. Just putting that in now and cutting back to it. So 2304 is in the district of Newcastle, Mayfield. And here we have 6,900 households, 25% own outright, 35% are borrowing and 39% are renting. Again, mortgage stress is pretty high, 70% of those are with a mortgage, 58% renting or in rental stress, and a small number of stressed investors. Overall financial stress is 50%. And the financial stress metric does have an impact on the trajectory of scenarios as well and where prices may go. 75% of houses, 5.8% of units, and some other types of property, like, for example, living over shops and other commercial premises, or indeed in other types of properties, for example, smaller huts and caravans, those sorts of things. People ratio is above 2, vacancy rate 6.7, gross investment yield is 3%, net investment yield is minus 1.6%. Again, I'll highlight all three postcodes we looked at so far have had net negative investment yields, which tells us something about the state of investment properties. Taxable income was 65,000 from the individual ATO data for the year 21-22, 82,000 from the census. The multi-flag comes up. That's because multiple incomes are feeding the mortgage. And that means that the disposal month is around $6,000, with 37.4% going on a typical mortgage at 2250 and 31.5%, 1894, going on the typical rent. And I would highlight that we continue to see these numbers above that sort of theoretical 30% of income, which people quote as being mortgage stress. Okay, we'll go on and look at the others. Just to say, I will look at the chat and get those from the chat shortly, but I'm just going to cover the ones that people asked for beforehand first so that I can tick that box and then we can move on. So looking at the next one, Bryden asked for Queensland postcode 4119. And that's Underwood in Brisbane and Moreton. Small account, 2319, 22% owning outright, 50% of borrowing, 27% of renting. Mortgage stress at 37%, a lot of rental stress. Now it says 100%, that's plus or minus a few percent because of rounding errors. Remember, I'm grossing up from my 52,000 household sample, so there's a little bit of, averaging there. 47% in financial stress, the households, that's quite high. You can see there that the households are mostly in houses, 84%, small number of units of the types of property. The people ratio is even higher, so lots of families, 2.89. Vacancy rates, 5.5. Gross investment yields 4, net investment yield is minus 0.5. Average taxable, 65,000 from the ATO, 103,000 from the census, giving a multi-flag, which gives a multi-income disposable level of about $7,000, with a third, 33.3, going on the mortgage, 2340, 28.41993 going on the typical rent. And you can see here the best case scenario for houses is going higher as units, and even the base case, maybe a small fall, but a bias to the upside on this particular postcode. Okay, let's go back to look at the next one. So Daryl asked for postcode 6230. This is in the Bunbury SA3, including Bunbury, Carey Park, and a whole bunch of other places there too. And you can see here that we've got 18,000 households in this area, 29% owning outright, 38% borrowing, 32% of renting. Mortgage stress is high, 73.9. Rental stress is high, 83.3. And I'm seeing this across a lot of Western Australian postcodes now with high levels of mortgage and rental stress. Overall financial stress at 61% is one of the higher ones we've seen. And you can see here we have 80% houses, some other units and types of property there. The people ratio is above 2. Vacancy rate was quite high. That could be some second homes and holiday homes in that area, possibly. Gross investment yield is 3.7. Net investment yield minus 1.2, so negative again. Average taxable 72,000. Household census 76,000, giving a disposal monthly around 5,500, with 33.1% or 1,820 going on the typical mortgage, and 27.2 on the typical rent at 1497. Sorry, 1495. I'm making the numbers up. And you can see here that the scenarios are best case scenario, further rises, base case, a slight fall in the next 2 or 3 years. Right, just keeping on my task at the moment with Janine. She asked for postcode 3850 Sale in Victoria. Okay, let's put that one up. And here we've got 6,700 households, 35% owning outright, 31% borrowing, 32% renting, mortgage stress at 81%, rental stress at 71%, financial stress at 51%. Unfortunately, a lot of mortgage stress in Victoria too. You can see here 85% of houses, some units, other types of property. Vacancy rate's quite high. The people ratio is just above 2, so some families. Gross investment yield is 3, net investment yield minus 1.7. Average taxable 67,000, 69,000 from the census, giving a disposal monthly of just over $5,000 with 31.1% or 1,560 going on typical rent, 27.8% typical mortgage, I should say, 27.8%, 1,395 going on the typical rent. And scenarios with regard to property prices, I'm still struggling, even in my best case scenario, to see much in the way of property growth in this particular area in Melbourne at the moment. You can see it's pretty much line ball, and the base case would be a more significant fall. Going to the next one, WA 6163, which is Samson. And they're 23,000 households, a third borrowing, a third owning, I should say, 39% borrowing, 27% renting, mortgage stress 75%. Again, another example of high levels of stress in these high growth corridors in Western Australia. 75% of houses, some of the types of property in the location. People ratios showing families 2.13, vacancy rate 8%. Gross investment yield is 4.2. Net investment yield is positive, 0.3% positive. Looking at the taxable income, 74,000, 85,000 from the census, giving a multi-flag, giving us a monthly disposal of more than $5,900, with 36.7% going on the typical mortgage, 2178, and 29.4%, 1745 going on the typical rent. And scenarios are positive for home prices in that particular area. Now, Anthony asked me to tell a tale of 2 different towns. So the first one was 3450, which we're going to put in now. And that gives us Castlemaine. And there we've got 3,400 households, half own outright, 26% borrow, 23% rent. We have mortgage stress at 64%, rental stress at 60%, some financial stress there. We have 92% houses. We have a people ratio of 1.8. We have a vacancy rate of 9. We have a gross investment yield of 3.1. Net investment yield negative, minus 0.9. We have average taxable, 61 versus 57, giving a disposal monthly of 4,000, with 40% going on the typical mortgage, 1,634, and 36%, 1,495, going on the typical rent. So that was the first one. And then he asked for 3,465, which is Maryborough in Victoria. And there we have 4,700 households, 47% owning outright, 27% borrowing, 24% renting. We have 87% in mortgage stress, 9% in rental stress. We have higher financial stress. We have 89% houses. We have a low people ratio, 1.92. We have vacancy rates, 9.7. Gross investment yield, 3.1. Net investment yield, minus 1.3. Taxable income, 52,000. Household census, 47. And you can see here, disposal month is 37, 34, 1,284, 1,196. So whilst at a superficial level, these two might look different, from a price point perspective, the dynamics are relatively similar, which I think is quite interesting. Okay, next one from Leanne, 4566. Just going to take a swig. Hang on. It's one of the problems when I'm just talking. I can't take a swig off camera. Noosaville. Noosaville, 4023 households, with half owning outright, 26% borrowing, 23% renting, 15% in mortgage stress, 71% in rental stress, some financial stress, but not as much as in others, 60% houses, units, 10% other types of property there too, very high vacancy rates, second homes, Airbnb, investment properties, part of the story, I think. Gross investment yields, 4.3, net investment yield, positive, 0.2. Average taxable, 84,000, census, 72,000. Disposal monthly of 4,700, with half going on the typical mortgage. Meteors scratching the carpet, you may hear it in the background. And investing, 51% from a rental perspective, 2,441. It's one of the reasons why stressed investors are doing reasonably well, I think. So that's that one. Okay, the next one is 2536, which is Catalonia. On the south coast of New South Wales, 8,400 households, 47% owning outright, 25% borrowing, 27% renting. No mortgage stress, but quite a lot of rental stress. 79% houses, small number of other types of property there. Vacancy rates very high, again, Airbnb and other types of second homes. 3.4% gross investment yield, small net investment yield, 0.6. Average taxable, 55. Household census, 61. Giving a disposal monthly of just over 4,300, with 43% going on the mortgage, 1,860. 40% on the typical rent, 1,745. Scenarios are positive in terms of property price moves over the next 3 years, at least on the best case scenario. Crackerjack asked for postcode 2229, 2229, 2229, which is Caringbah. It's in the district of Sydney, actually in the Cronulla area, Sutherland. 12,300 households, 37% owning outright, 39% borrowing, 23% renting. Just a small number in mortgage stress, but rental stress at 89% is very high. Some investor stress, overall financial stress at 31. 53% of houses, more units, of course, and other types of property in this area. Quite high people ratio, so that's going to be families. Vacancy rates were quite high too. Gross investment yield 3.4, net investment yield is minus 0.9. Average taxable 98,000. The multi-flag comes up because the household census at 116,000, giving a disposal monthly around $7,000, with 51.4% going on the typical mortgage, 3600, and 35.6%, 2492, going on the typical rent. Scenarios are positive for prices over the next 2 or 3 years. Now, Sean asked for postcode 3044, Pascoe Vale. 11,800 households, 31% owning outright, 37% borrowing, 31% renting, a lot of mortgage stress, quite a lot of rental stress, 65% in financial stress, 59% are houses, some other types of property there in the area too. The people ratio is at 2.29, meaning families as well as individuals. Vacancy rate was quite high at 8.4%. Gross investment yields 3.4, net investment yield minus 1.4. Average taxable, 80,000. The multi-flag comes up because the census said 108,000, giving a disposal monthly around $7,200, with 36% going on typical mortgage, 2600. 27.6% or 1999 going on the typical rent. And scenarios are not very positive with regards to future price growth in that particular area. Okay, so that's pretty much all of the ones that I came across from the comments in the earlier shows. And what I'm going to do now is I'm going to have a look on the chat. And I got from Bossman a request for a couple before the show. So let's just go straight to Bossman's question. He asked for postcode 4510, which is Cabilchar in Brisbane and Moreton. And you can see there that we have 21,000 households, 26% owning outright, 36% of borrowing, 37% of renting. Mortgage stress was at 13%, but the rental stress was high at 90%. We had some stressed investors and the overall financial stress at 42%. 83% of houses, small number of types of property there in the mix. People ratio is 2.43, so it's on the high side. Vacancy rate was at 6.9. Gross investment yield 4.4. Net investment yield positive, just 0.1%. Average taxable 55,000. The multi-flag is up because the household census said 68,000, giving a disposal monthly of just under $4,700, with 40.6% going on the typical mortgage, 1906, and 34.5%, 1619, going on the typical rent. And I will say that when you're seeing some of these households with slightly lower levels of disposable monthly income, the percentages are much higher than those with bigger incomes generally. If you're looking at the scenarios, you can see there that the scenarios in the best case are very significantly higher over the next 3 years. The base case, sideways. Now, we also got asked from Bossman for postcode 4519. And that was Biwa. So Biwa is again in Brisbane and Moreton, 3565 households, 32% owning outright, 43% borrowing, 24% renting, very small number in mortgage stress, highly rental stress though, 100% in my numbers, 34.9% in financial stress. 88% of houses, small number of types of property there. The people ratio is high, so that's families, 2.52. Vacancy rates above 5. Gross investment yield is 4.3%. Negative investment yield of minus 0.2%. Average taxable 61,000. The census said 79,000. The multi-flag comes up, giving 5,300, which means 38.8% going on a typical mortgage at just over $2,000 a month, and 36.2% at 1944 going on the typical rent. Scenarios are price growth in the best case scenario, going sideways on the other scenario, which is, probably more likely, frankly, but we'll see. I guess the truth is nobody quite knows what the RBA is going to do. I just have a feeling that the RBA may not be going to cut as dramatically as people were thinking about. Right, I'm now looking at the chat. I'm just going down the chat to see what I can see and see whether there are other questions that people would like me to look at, or indeed look at the postcode questions. What do we got? Interestingly, yes, just remind everybody, would you please like the show? It's really important to help the algorithm. And if you haven't subscribed, please subscribe to it. It really does help. I was saying in the chat before the show that the algorithms are not being very kind to me at the moment. I deliberately style my shows like I do, not to sort of maximize the algorithm. If I got angry and, if I got more abusive and all those things, I'd probably get more algorithms support. But I am doing it the way I want to do it. So that means that I'm really reliant on those who like and share. And so it's really important that we actually do that, please. And just looking now, 3008 says, Drew, the wind tunnel of Melbourne. We'll do 3008 then. I can remember walking around Melbourne in a gale and getting nearly blown off my feet, and the cold. Oh, it was so cold. Oh dear. Yes, I remember it well. Okay, let me just bring that up. Going to remove Drew's comments. 3008 Docklands. Right, 8,100. 13% owning outright, 19% borrowing, 67% of renting. 40% in mortgage stress, 80% in rental stress, 70% in financial stress, 32% of stressed investors. So there's a lot of people there underwater, as we'll see in a second. Mostly units, of course, in that era, you'd expect that to be the case. People ratio is very low, so a lot of individuals, as well as maybe couples. Vacancy rate was very high. Of course, Airbnb, short-term rentals and all those things there too. Gross investment yield is 4.3, but net investment yield is negative, minus 0.8. There are a lot of people losing money, hand over fist, in the Docklands area. Average taxable A6,000. The census said 101,000. The multi-flag comes up with the disposal monthly around 7,400, with 32.2% or 2,400 going on the typical mortgage and 27.5%, 2,048 going on the typical rent. Looking at the scenarios, because of this pressure on the unit sector, even in the best case scenario, there's not much here in the way of price growth over the next 2 or 3 years, and the base case would be a more significant fall. So I think that tells you all you need to know about this particular one. There are a lot of people who have actually done very badly because of the investments that they made out in and around Docklands. And of course, the pressure is remaining. Okay, Lee asked for postcode 2464. Which is Yamba. And here we have 3,200 households. We have 52% owning outright, 21% borrowing, 26% renting. We have a lot of rental stress, 85%, no mortgage stress to speak of, and overall financial stress isn't too bad, 29%. We have 76% in houses, more units, the types of property there. The people ratio is 1.62, so including some individuals. 24% vacant, very high. Airbnb, maybe. Second homes, maybe. Other investment properties, possibly. Gross investment yield is 3.5, net investment yield is minus 0.7. So again, another case of losing money from a cash flow perspective. Average taxable 58, household census says 59. That gives a disposal month of just over $4,000 with 48.2% going on the typical mortgage, 1930, and 49.8% at 1993 going on the typical rent. That's interesting that the rental is, slightly higher. Scenarios, best case, yeah, there's a bit of a rise possible. Base case, not so much. Okay, let's look at the chat again and see. Matt B said 4740. Mount Pleasant. Only said Pheasant there, which is not quite right, is it? Mount Pleasant. Okay, in Mount Pleasant, 33,000, big area, 33,000 households, 27% owning outright, 39.7% borrowing, 32% are renting. Mortgage stress, 46%, more than 6,000 in mortgage stress, 51.9%, more than 5,000 in rental stress. Some stressed investors as well, more than 12,000 or 37% of households in financial stress in the area. Mostly houses, 81%. Some units, so that's a property. People ratios, 2.23, so that's going to be families. The vacancy rate, 9.6% on the high side there, so perhaps Airbnb and other types of second homes. Gross investment yield, 4.2. Negative investment yield, from a net perspective, minus 0.1. Average taxable, 80. Average from the census, 95 on a household basis. The multi-flag comes up, giving a disposal monthly of 6620. 31% going on the mortgage, 2080. 25.6%, 1694 going on the typical rent. And you can see here that even in the base case scenario, there's a small rise in property prices, but the best case suggests a very significant rise. This is not pre-recorded. This is live as you go. So just to be clear, this is me chatting now live, just in case you had anyone think that this is all pre-recorded. Forget it. This is me and the chat. All I did was to go through the ones that I had previously. Wiggler says, Bairnsdale 3875. Okay, 3875 Bairnsdale, 8506 households, 8,506 there. 43% are outright, 32% are borrowing, and 23% are renting. 64% are in mortgage stress, 71.5% are in rental stress, and we also have some financial stress there. We have 89% houses, small number of units, so types of property. We have a vacancy rate of 9.7%. The people ratio is above 2, so perhaps some families. The gross investment yield is 3.3. The net investment yield is actually minus 1.1%, so that's not very good at all. Again, I quite often see this, that when you actually calculate the real returns, they're much lower. Average taxable 57. Household census said 64. That's a disposal monthly of just over 4,600 with 33% going on the mortgage, 1560, 29.9%, 1395 going on the typical rent. And from a scenario perspective, even in the best case, I struggle to see much price growth in the time ahead. Okay. Iggy asked, am I taking account of the dollar devaluation? So when I run my economics, I have 5 or 6 different elements that are driving the scenarios. Obviously, the interest rate, bond yields, inflation, and also the exchange rate are all part of the matrix that drives it. And I try to take account of those things. I also take account of the migration, so the demand, and also the broader economic data with regard to things like employment. All those things are part of the matrix that drives it. And it's also influenced by the levels of financial stress. So the more financial stress there is, the more likely the downside will be stronger, simply because, of course, there are more people potentially needing to sell. Okay, K. Bell says, can we see the data for 3978? Hopefully can. Let's see. I have more than 2,000 postcodes in, so generally they come up. Small ones don't always. Where we are. Let's have a look. Yep. Clyde is the area. Casey South, Melbourne Southeast. 14,000 households, 7.1% owning outright. Look at this, 69% are borrowing. This is a massive mortgage belt. 23% are renting. And you can see there that 10% are in mortgage stress, 75% are in rental stress, some stressed investors as well. You can see we've got mostly houses. We've got a very high people ratio, so a lot of families, more than 3. We've got a vacancy rate of 3.2%. We've got a gross investment yield of 3.6. The net investment yield is still negative, minus 0.6. We've got an average taxable around 63,000, but the household census at 112,000. So the multi-flag comes up, multiple income supporting, giving a disposable monthly of around 6,770, with 38% of the mortgage payment coming out of that, $2,600, and 29.9% at 2,023 on the typical rent. And you can see that the scenarios are positive here. Certainly more positive than some of the other ones. In the best case scenario, maybe up 6 to 7% over the next 3 years. The base case would be a bit of a fall. And I would make the point that we do see here the relatively high proportion of income, but the stress levels are still relatively low in this area at the moment. Okay. What else have we got? Seeing whether there are any others. Yeah. Be chic. Wonder whether that's a real name or a command. I'm not sure. I'll try and be chic. 6163. This is Samson. I think I did Samson in the location of Brown before, didn't I? I think I did. Anyway, I will just reprise it in case I'm incorrect on that. I thought I did it. Let's put it up. There you go. Get rid of that. So you can see here, 23,000 households, a third owning outright, 39% borrowing, 27% renting, 75% in mortgage stress, 75% of houses, 8% vacancy rate, people ratio says families, 4.2%, positive net investment yield, multi says 85 compared with 74, giving a disposal monthly of around 5,900, 36%. Going on the mortgage, 2178, 29.41745. Going on the typical rent. The other was a mortgage, of course, mortgage payment. And you can see there strong scenarios for future growth in the area. WA looks as though it's continue to grow. Cookie says, postcode 2750. Yes, absolutely, 2750. And glad you love the clippings. Thank you for sending to me, Cookie. I couldn't do it without you. Really makes a huge difference. This is the Penrith story. And you can see here that we have 20,000 households, 26% owning outright, 30% borrowing, 40% renting, 55.6% in mortgage stress, 67% in rental stress, small number in stressed investor land, and 46.9% in financial stress overall. 65% of houses, some units, other types of property. People ratio says families. Vacancy rates a little higher, perhaps that was due to the COVID situation at the time. Gross investment yield is 3.2, net investment yield is minus 0.8. The taxable income, 68,000. The multi from the household census, 86,000, giving a disposal monthly of around 5,900. 41.8% of the mortgage payment, or $2,495. 32.5% going on typical rent at 1,944. And you can see here the scenarios are showing quite positive growth in the best case scenario, not so much in the base case. Okay. Let's have a look, see what else I've got. Nada asked for 3805. Narrow Warren, one of my favourite postcodes, not least because, of course, it pops up quite near the top of the list quite often. High growth corridor. 19,300 households with 24% owning outright, 53% borrowing, 22.7% renting. 94% in mortgage stress. Ooh, that's very high, more than 9,000 households. 92% in rental stress, more than 4,000 households. Stressed investors are 15%, and overall financial stress at 74.9%. Mostly houses, 92%, small number of types property there. People ratio, very high. So again, example of families living in this area, as you would expect. The vacancy rate at 3.3, very low. Gross investment yield is 3.5%. Net investment yield is minus 1%. So again, from an investment perspective, many people here are underwater. You can see here that the disposable income from a taxable perspective, 62,000, from the census, 100,000, multi-flag comes up, giving a disposable income of 6,552, with 33.6% or 2,204 going on typical mortgage, and 28.9% at 1,894 going on the typical rent. And unfortunately, with all of that stress in the area, even in my best case scenario, I'm not seeing much in the way of property price growth over the next 3 years, unlike some other areas we looked at. Now, Chris asked for postcode 3930. Mount Eliza in Victoria. And here we have 6780 households, 44% owning outright, 46% borrowing, 8.3% renting. We had mortgage stress at 17%. We had rental stress at 80% and overall financial stress at 21%. We have 91% houses, small number of types of property there. We have 2.64, the people ratio, vacancy rate at 6, the gross investment yield at 3.3. Again, a negative net investment yield, minus 0.8. Average taxable, 110. Household census, 132,000. Multi-flag comes up, 8,057. Average disposable monthly income, giving 38.7%, or 3,120 on the typical mortgage repayment, and 31.7, 2,550 going on the typical rent on a monthly basis. Scenarios are small price growth over the next 3 years. On the best case scenario, this is cumulative, of course, 4.7% over 3 years. Not so much on the base or worst case. ANZ Anon, thank you very much for the super chat. Really appreciate it. Just to show I was live. Thank you very much. And then you also asked for 4570. Which I'm going to put up now, 4570. Thank you very much, super chat. Really appreciate those who do support us on the channel here. It makes a huge difference in terms of being able to do what we do here. Okay, so this one is Mother Mountain. And let's get rid of that so you can see everything. I'll put this up. 18,900 households, 41% owning outright, 37% borrowing, 21% renting. A third in mortgage stress, 73% in rental stress. Overall financial stress of 36%, 92% of houses, small number of units, types of property. Ratio of 2.22 on the people front, so that's going to be families. Vacancy rate was on the higher side, 4.4% gross investment yield, positive net investment yield, 0.5% positive in this particular area. And generally, we do see investment yields in Queensland better than, say, Victoria. 55,000 taxable income, 60,000 from the census, giving a disposable monthly around 4,100. 37.6% on the typical mortgage at 1,560, and 35.4, 1,470 going on typical rent. And again, it's the same story. It tends to be a little bit of a lower disposable monthly income gives a higher rental problem and mortgage problem. Okay, next one, TNN 5214. I think that's the first Adelaide exploration, so thank you for that. This is Goolwa North in Outer Adelaide. 4,600 households, 53% owning outright, 25% borrowing, 21% are renting. No mortgage stress to talk of, but 87% of those in the rental sector in rental stress, more than 800. And we've got some financial stress there too. We've got 89% houses, small number of types of property there. Vacancy rates a third, which could well be second homes, maybe, Airbnb, maybe, I don't know. 4.3% gross investment yield, negative net investment yield, minus 0.3. Average taxable 51, household census 48,000, giving $3,200 with 44.6 or 1438 going on the typical mortgage and 42.8, 1380 going on the typical rent. So again, it shows you as we have more compression on disposable monthly income, the proportion going to pay the mortgage or rent tends to go up. Scenarios are very positive here. I mentioned Adelaide earlier on looking very strong at the moment, and it's likely it's going to continue. Alison said, I'm getting hired, still here. Well, hang in there. We're we've got about another 15 minutes or so to go to get to the end of the show. So hang on if you can. Really appreciate it. But I know that some people find the timing a bit difficult, but I find the 9 p.m. was too late, 7 p.m. was too early, so 8 p.m. seems to work for me. Drew says, you decide. Please like. Absolutely. Please do like the show. Really does help to get this out. Kay Bell says, very interesting. Thank you. Yeah. And it is interesting. When you start making comparisons of different postcodes, you can see here that, things are not uniform across the country. This is why I say you can't assume every single property price is going to go up. You can't assume that every household is in difficulty. It does vary. It does vary considerably by different locations. Now, MCMM asks for 3073. I've nearly caught up now, which is good. 3073, which is Reservoir in Victoria. And there we have 21,800 households. We have 6,900 or 31.6% earning outright. Very similar number borrowing, slightly more renting, 65% in mortgage stress, 67% in rental stress. Overall financial stress at 48% is quite high. We have some houses, but we have types of property and units there too. We have a slight high people ratio, so some families. The vacancy rate was on the higher side. I wonder whether that's an area that students perhaps rent in as well. I'm not sure. Gross investment yield is 3.1, net investment yield minus 1.1. Again, we quite often see that in the Melbourne area. Average taxable 66,000, household census 80,000, giving the multi-flag and a disposal monthly around 5,900. 40% of disposable monthly income paying the mortgage, 2,383 on average, and 30.3% on average, 1,794. Cookie Boy makes a point. The Fed calls on rate cuts have now, push the right button. There we go. Yes, exactly. The Fed was sort of sitting on the sideline, but now it's being kicked out. That could have a profound impact on other central banks as well, by the way, and maybe even the RBA. So I'm going to look at the poll now because that's going to be quite interesting and say, do you expect to see rate cuts in May? Interestingly, we've got 38% saying yes, a rate cut in May is likely. We've got 43 no, saying it's unlikely, it's not going to happen, which is interesting. That's gone up. So earlier on, there were more people saying yes. And interestingly, 19% are not sure. So there you go. That's the latest poll. So thank you to those who participated in the poll. It's more than 100 votes on the poll this time, so really appreciate that. And quite interesting. I quite like using the poll to get some soundings as to what you guys are thinking. Okay. Richard asked for 3216. This is Hyson in the area of Geelong. 24,000 households, 35% earning outright, 37% are borrowing, and 26% are renting. 55% are in mortgage stress, more than 5,000, 81% in rental stress, more than 5,000. 47% of households in financial stress, more than 11,000 overall. 84% of houses, small number of units, and types of property there. The people ratio is saying families at 3.32. Vacancy rate was just over 5. Gross investment yield is 3.5. Net investment yield minus 1.1. Average taxable, 70,000. Census data said 89,000. The multi-flag comes up because it's higher, giving a disposal monthly around $6,000. 34.4% going on the typical mortgage at more than $2,000. 29.7, 1,794 going on the typical rent. And you can see here the scenarios are not much growth, even in the best case scenario. Now, Zoas asked for 5159. Happy Valley. I love Happy Valley. Very good. Just get rid of that. Different Happy Valley from the BBC series, I might add. Okay. 13,500 households. 35% owning outright. 52% borrowing. 12% renting. 27% in mortgage stress. 90% in rental stress. 8.7% in investor stress land and 27% in financial stress overall. 93% houses, small number of types of property there. 2.46, so again, families. 4.1% in vacancy land, so very low. 4.3% gross investment yield minus 0.2% net investment yield. On average taxable 65,000 compared with 93,000. Multi-flag comes up for the census, giving a disposal monthly of $6,200 with 30%, 1,908 going on the typical mortgage. Typical rent at 28.5%, 1,769. Scenarios are positive. In the best case scenario, with more price growth ahead. And again, I'm watching Adelaide going up a lot. Drew says, like, or else. Thank you, Drew. Keep batting for me. I really appreciate it. Yeah, please do like the show. It really does help. Makes a huge difference, particularly with all that I do. Thank you. I really appreciate that. And thank you very much for the super chat. Thank you. Love it. Thank you very much. Really helps. That's the first super chat from you. So thank you very much. And also, thank you so much for the support and really appreciate that. Thank you very much. And you also asked for another one, 4032, which I'm happy to do. So this is Chermside West in Brisbane and Moreton. And thank you very much for the super chat. Really appreciate it. 8,500 households, 23% owning outright, 24% borrowing, 52% of renting, 62% in mortgage stress, 65% in rental stress, overall financial stress, 53%. 42% of houses, lots of units and types of property there. The people ratio is a little bit lower, so maybe some individuals and couples as well as families. The vacancy rate was a little higher, 6.4%, so possibly second homes and things like that there, I'm not sure. 4% gross investment yield. Net investment yield is positive, just 0.1%. It's one of the lower ones in around Queensland, I think. 68% is the average taxable. $68,000 is the average taxable, I should say. 82,000 is the census data. The multi-flag comes up, giving a disposal of around $6,000 with 36.9% or $2,263 a month going on the typical mortgage and 31.3 or $1,918 a month going on the typical rental payment. Scenario is looking quite positive for growth in the scenario where we don't get any rises in interest rates and we get rate cuts coming in quick succession. Zoas asked about Linger and Dye Ridge. I don't know. I did a quick search, couldn't find it. So maybe it's one I should look up later when I've got more time. So couldn't see it. Okay, well, we've caught up, which is great because we're quite close to the end of the show now. And so it's worth me just going back to a couple of other little points I wanted to make. One of them is that the story of scenarios is quite interesting, and I will just share with you my scenarios for the main states. This is an aggregate higher than I shared previously, but it gives you a bit of a flavour of what's going on. So let me just put that up. Go there, go slides. Yeah. So this is WA. You can see here that the best case scenario for WA overall is a 21% rise over the next 3 years. The other two, of course, less positive. Units pretty much following on. You can see that if I go to Queensland, the best case scenario is a 90% rise over the next 3 years. The other scenarios, of course, are less positive. Units following on. You can see there that South Australian prices, 20% over the next 3 years, best case scenario. And again, flat base and a fall, worst case scenario, units following on, you can see there. If we look at New South Wales, 13% over the next 3 years, best case scenario, and the others less positive. You can see there, and units following on as well. And if we go to the ACT, 8% best case scenario, worst case, and the one in the middle is a bit of a fall possibly, but I'm probably biased now more to the best case scenario because of what I think the RBA is likely to do. And you can see there that even Tasmania is looking for a small rise, 6% over 3 years. The base case and worst case is a more significant fall, and units following on as well. And if we look at the Victorian scenario, 5.5% over the next 3 years, best case scenario, but a bigger fall, of course, than some of the other states if things go pear-shaped, and units following on. I also did the NT, although I mentioned before the NT is, well, frankly, difficult because the scenarios are based on very small accounts. But nevertheless, you can see there 21% best case, and the worst case, a bit of a fall. So it gives you a flavour. And just to be clear, I am saying that there is definitely a scenario where prices go up from here. Depends on the broader economics, but I'm certainly not only calling for price falls. I am saying there is a path to higher prices. Now, as towards the end of the show, I just want to come and just leave a couple of final messages with you all, because those who are actually struggling, and there are a number who actually struggle, it is worth getting help, and it's very important to get help from the right sources. So I recommend the National Debt Helpline, 1-800-007-007, government-backed, of course, very busy at the moment. They get a lot of calls, but they can actually help. So if you have a debt problem, it's worth talking to them, and that's whether you've got a mortgage or whether you've got a rental problem. Also, if you want to try and get your statement of position sorted out, this tool from AFCA is really brilliant. It's an online tool that you can put in your household income, expenses, and other assets and debts, and also what your proposal is. That's really useful if you're going to talk to your bank. Remember, talk to your lender if you have an issue, and those sorts of things. Talk to your bank, of course, but be careful, because they're going to actually try and persuade you to do things in their interest, not necessarily in your interest. And I always get frustrated when people say, well, the bank said extend the mortgage, and so you're suddenly paying a lot more interest, and you've gone interest only. And sometimes then a year later or 2 years later, you actually have the same problems. The problem is that ASIC highlighted. When you talk to the bank, if you're not careful, they help them, not yourself. So this financial position tool from AFCA is really powerful. And generally, I say to people, understand your cash flow, money in, money out, prioritize where the money's going, look at debts with a high interest rate and focus on those first, and be careful about leveraging up. I mentioned the credit card debt that's rising. I'm concerned about the amount of debt that's building, and the fact that more households are struggling because of this high debt burden. And remember that credit card debts, the rate of interest won't drop. A lot of fixed borrowing won't drop even if interest rates come down. And of course, some people do have fixed rate mortgages and are still struggling. There are others that are actually coming to the end of their fixed term and are considering now, do I fix or do I go variable? Well, chances are rates are going to drop from this point. So just be a little bit careful if you lock in. The fixed rates do tend to be a little bit predictive, and they are driven off the bond rates. And it's interesting that cookie actually through this thoughts on bonds. The fact of the matter is, look at Japanese bonds, look at other bonds too, they're higher. So the bond market is saying there's a higher risk premium than previously. Government debt is going to be higher. The rate of return on that debt is going to be higher. That could leak through into mortgage rates. That could leak through into higher interest rates and may actually cause a problem later too. So that's just something to think about. Rates are likely to be higher for longer. Rates are going to be difficult for many people. So, be cautious, be careful. The other point I'd make is there is this rush now for some people to say, oh, prices are going up, I need to buy. Just be careful, be cautious, because you can over leverage quickly. And of course, if things don't play out quite as you expect, you can get into some difficulty too. So I always say, run some scenarios, run some thoughts about what if I'm wrong? What if the other scenarios play out? Gives you a little bit of a flavor. Now, if there's a postcode that I didn't cover tonight you'd like me to cover, I'm happy to send you the one-page summary, the snapshot, if you contact me by the DFA blog and put your request in there. I quite often get a few requests after the show, so it might take a few days to get that, but I'm very happy to do that. Also, if you're interested in supporting me, you can do that via Patreon, and thank you for all those who do actually support me regularly via Patreon. It makes a huge difference. It covers the cost of running the show. Within that, there is a tier relating specifically to the data that I share, this postcode data, this 2,000 plus postcodes that I update every month. If you want to subscribe to that, this is $50 a month plus GST, and you can subscribe. I'll be sending this data out for all 2,000 postcodes in the next few days for those on the Patreon, and hopefully people find that useful. You can look at a lot more information than is shared in my show tonight. More postcodes, you can make comparisons between different postcodes. And if you're, for example, looking at things like, well, where is the best postcode from an investment return? That's in the data. Where is the highest levels of stress? That's in the data. So you can actually do some comparisons. So it's a very powerful tool. And I have a number of people who generally subscribe to get that via Patreon. It's available. It'll be sent out in a few days' time. So if you want to grab it, that's the way of doing it. As I say, if you want one particular postcode, send me an email, and I'm very happy to try and help on that. And by the way, I will also make the point that if you want more information about what I do, you can go to my blog. The blog there, digitalfinance.com/blog, actually includes the dialogue where you can actually ask me a question directly at any time, or indeed find information about, for example, the one-to-one and the other things that we do. Also, just briefly mention that the walktheworld.com.au website gives you a lot of information about what I do and the other stuff they get involved in. So that's a good one to make note of. And as well as the blog, if you want to make a one-off contribution, you can via PayPal. Really appreciate those who do that from time to time. It really helps. And finally, if you are interested in contributing via Bitcoin, I even have that capacity via Bitcoin as well. Now, I did see people were sort of getting ready to sign out. Alison said, thank you. And Smooth has said, hold on. I'm holding on, hold on for the rocket. Yeah. And A23 asked for 3033. So, 3033. I'm going to do that. This is the last one tonight, okay? Because I'm running out of voice, running out of time and all of those things. This is Keller East in Melbourne. Okay. Keller East in Melbourne. 5,800 households, 46% earning outright, 34% borrowing, 90% renting, 14% in mortgage stress, 66% in rental stress, 11% in stressed investor land, and overall financial stress at 22%. 80% of houses, some of the types of property there too. People ratio is high, so that's going to be households. Vacancy rate was 6%. Gross investment yield is 3.2. Net investment yield minus 0.9. And the taxable income, 81,000, compared with 99,000 for the multi, giving a disposal monthly of 6,417 with 40%. I think it's one of the highest we've seen. $2,600 a month, 31.5% on the typical rent, 2023. And scenarios are a bit of growth, possibly so. And there you are. We're pretty much at the end of the show. So thank you very much for spending time. Cookie, thank you very much for the super chat. Love it. The dogs will have an extra pub crawl. Thank you very much for that. Greatly appreciated. And Cookie, to you, thank you very much for all the support you provide for me with all of the clips and everything, because they really make a huge difference. They really help to ground the show in the in the reality of what's going on. So there we are. I think we're pretty much at the end of the show. The good news is the dogs are in their baskets again. So we've got 2 dogs looking pretty cozy. It'll be time for the next walk, I think, very soon. So that's going to be what I'm going to be doing next. And I hope everybody has a good evening and a good week. Check out next week's show. Next week's show will be on property market. And we're going to be talking specifically about some of the tricks that agents are using and why we need to see through them. So that should be a fun conversation. So I look forward to that. Make your diary available for that. And also, of course, you can check out the recorded shows all the days of the week. Shows come every day of the week. And also I do make shorts every day of the week as well. So you can check those out if you want a little nibble of insight rather than the full Monty, which of course takes a bit longer. Some of the shows are a bit long, but hope you enjoyed those anyway. So thank you very much. And Cookie says, yeah, I absolutely agree. The loyal followers, I really appreciate those who are following me on a regular basis and all the comments and everything else. It makes a huge difference to me that the community is so vibrant and strong, and that we have a good banter going on in the chat. It's also a very respectful community, which I really appreciate, and I want to say congrats to all those who have helped to make it what it is. Anyway, that's it. Thank you very much for spending some time with us this evening. Have a good week. I look forward to seeing you next week, and have a good time in the meantime. This is Martin North from Digital Finance Analytics, signing off. Cheerio.